Today I'd like to talk about depreciation. As you recall, depreciation is what happens to an asset after it's purchased because it starts to lose value. If you buy a car, for example, you may pay $10,000 for it today, but you know that a year from now it might be worth $7,000 or $8,000. Now, for companies, depreciation is very important because in order to measure the worth of the company properly, assets have to be evaluated at an appropriate value. You recall from looking at the balance sheet, under fixed assets, for example, production equipment, depreciation is recognized as an entry on the balance sheet in order to determine a fair representation of the current worth of that asset. Now, depreciation can be calculated a variety of different ways, and there's probably a dozen different ways to calculate depreciation, depending on what the information is to be used for. In this course, we're going to be looking at two different ways of calculating depreciation, what's called the straight line method and the declining balance method. The idea behind the straight line method is that the depreciation, or the loss in value of the asset, is spread evenly through the life of the asset. There are two symbols I'm going to be using, DC and BV. DC is depreciation charge, the annual depreciation in year N, and BV is book value. And book value means the calculated remaining value of the asset. For the straight line method, we can see the book value of the asset as a straight line between the first cost, P, and the salvage value after N periods, S. It is assumed to lose value evenly throughout the life of the asset, and thus the term straight line. To calculate the depreciation charge, that is how much it loses each year in value, you simply take that first cost P, subtract the salvage value S, and divide by the number of periods. So it's an even amount every year that the asset loses its value. The book value, the remaining value of the asset, then is simply that first cost minus the depreciation charge over however many years is under consideration. Because the asset loses value by that amount each year, its remaining value is simply the accumulated depreciation subtracted from that first cost. So this is a very easy calculation. You'll note that depreciation charge is independent of the year in which the charge is calculated. In other words, small n does not appear in this formula. The other method of calculating depreciation that we're going to look at in the course is the declining balance method. The idea behind the declining balance method also comes from our study of accounting. Recall that in the income statement for a company, depreciation shows up as an expense. There's actually a cost reflected in the loss of value of the asset. And this cost can offset revenue and thus reduce profit. Now, there's value in reducing profit because by reducing profit, or the profit you recognize in your books at least, you pay less taxes. So it's to a company's advantage to recognize depreciation as early as possible in order to gain the money that would otherwise be spent on paying taxes. They're going to have to depreciate the asset fully eventually anyhow. But the slower they depreciate it, the more taxes they have to pay earlier. And they'd rather have the money earlier so they can invest in something else. So by and large, companies want to have depreciation follow a curve which is steeper at the beginning than the straight line method shows. Because the steeper the curve, the more depreciation they can charge earlier, thus pay less taxes earlier and have that money to invest in other things. So that's the motivation behind the declining balance method. It also reflects, perhaps more accurately, the way things do, in fact, depreciate. We know from our own personal experience in, for example, buying a car, that the amount the automobile depreciates in the first couple of years is much greater than the amount it depreciates after 5 or 6 years. It loses its value more quickly. And the same probably can be assumed to apply to a lot of different assets. Not all of them. For example, a house might in fact appreciate over time. But by and large, the vast majority of assets probably do follow a depreciation pattern, which is more similar to this one, which is evidenced by the declining balance calculation. Now, in the declining balance method, the principle is that the asset depreciates by a given proportion each year. That proportion is called D, the depreciation rate. So, for example, given a particular book value, looking at the depreciation charge equation, given a particular book value in some year n-1, the depreciation charge is simply that book value times the depreciation rate. So in the first year, that book value would be the first cost, and the depreciation charge in the first year would be P times D. But in subsequent years, and in general, it's the book value at year n-1 times D. The book value can then be calculated as P times 1 minus D raised to the nth power. And that 1 minus D raised to the nth power simply accumulates that depreciation charge on a year-by-year basis over the small n years. So now note a couple of things with the declining balance method. You need a depreciation rate. A different value for the depreciation rate will change the shape of the curve that reflects the remaining value of the asset. Secondly, salvage value is not involved in the declining balance method. We don't recognize the salvage value as having an effect on how the asset depreciates. We can see that in our graph here. First of all, I have the 3 different depreciation calculations here. This one is straight line. Both of these are declining balance. The top one with D equal to 0.2 and the bottom one with D equal to 0.5. So the value of the depreciation rate here has a dramatic effect on the shape of that curve. This curve, of course, is the book value or remaining value of the asset over time. So with the larger depreciation rate, the value of the asset decreases very quickly in time, and less depreciation rate decreases more slowly. The salvage value is not involved here. That salvage value could be anywhere on this chart, and it wouldn't affect the shape of the 2 curves associated with the declining balance calculation, although it would, of course, with the straight line calculation. And in fact, according to the declining balance calculation, the value of the asset never goes to 0. It approaches 0 asymptotically, but in fact, there's always some remaining value to the asset under the declining balance calculation. Whereas under straight line, after n periods, we make no statement about the value of the asset. We could sell it or assume it's 0 or whatever. So we have these 2 techniques, the declining balance and straight line method for calculating depreciation. And by and large, the way to distinguish between them in terms of use is that for internal calculations of the worth of the company, straight line method is probably advantageous because it gives a relatively high value as the remaining value to the assets, and thus perhaps evaluates the company as having more worth than would be otherwise calculated using the declining balance method. However, particularly for taxation reasons, the declining balance method is preferred because it allows you to depreciate the asset more quickly, which then lets you count that depreciation charge as an expense, which reduces profit, and then, in the end, reduces the tax you pay earlier. So let's do an example. Waterloo Data Services has purchased a new mass storage system for $25,000. It's expected to last 6 years with a $10,000 salvage value. We're asked to determine several things using both the straight line and declining balance methods, and we're given a depreciation rate of 0.4 for the declining balance method. First, the depreciation charge during year 1. Well, under straight line, the calculation for depreciation charge for year 1 is going to be the difference between that first cost and the salvage value, so $250,000 minus $10,000. Then divided by the number of periods of 6, which is $40,000. So in other words, under the straight line method, we're calculating a loss in value for this mass storage system of $40,000. Under declining balance, the calculation is going to be that first cost of $250,000 times the depreciation rate of 0.4. It was $100,000. So you can see here under the two methods, there really is quite a big difference of $60,000, which would effectively be a savings of $30,000 in taxes for the company. B, the depreciation charge during year 6. Well, in a straight line, we know that the depreciation charge is always the same. It's going to be $40,000 again, because it's independent of the year in which we do the calculation. However, for the declining balance, the depreciation charge in year 6 is the book value in year 5 times the depreciation charge of 0.4. The book value in year 5 is $250,000 times 0.6, that's 1 minus d, raised to the 5th power, and that's times 0.4. And that works out to be $7,776. Now, because we had the larger depreciation charge earlier with the declining balance, that has to be made up for later, in essence, which is why this depreciation charge is smaller later. Book value at the end of year 4. Under straight line, the book value at the end of year 4 is going to be our first cost of $250,000 minus the depreciation charge over 4 years. We know the depreciation charge is $40,000. Multiply that by 4, and that leaves us with $90,000. Under declining balance, the book value year 4 is our first cost times 1 minus 0.4, or 0.6 to the 4th, which is $32,400. So again, because we're recognizing a quicker loss in value of the asset under declining balance, its worth after 4 years is recognized to be less than under straight line. And finally, the final calculation I want to demonstrate is the accumulated depreciation at the end of year 4. Accumulated depreciation here is simply how much the asset's been depreciated from its first cost. Or in other words, its first cost minus its book value at the end of year 4. So under a straight line, we already calculated the book value at the end of year 4. So the accumulated depreciation at end of year 4, I'll use that notation here, is the book value, the first cost minus the book value at the end of year 4 equals $250,000 minus $90,000 equals 160. And under declining balance, going to be the same calculation of the first cost minus the book value at year 4. The book value is different in this case, though. It's 32,400, meaning that the accumulated depreciation is 217,600. So these calculations are fairly straightforward using the formulas. You have two different methods for calculating depreciation, and the book value and accumulated depreciation, all the other kinds of things you can calculate around depreciation. Recall, however, that these are only two of perhaps dozens such methods which can be appropriate at certain times. The one that we'll be looking at in particular for taxation is the declining balance method. Thank you.